that they have to link their lending rates with some external benchmark rate. External benchmark rate means the rate at which is external to the bank. The banks internally, it is not decided. Two rates have been defined for the external benchmark rate. One is repo rate, another is Government of India's 3-month or 6 months treasury yield bonds. So as and when all your bank's loans are linked to repo rate or the government treasury yield rates, as and when the repo rate or the treasury yield rate move up and down, accordingly your loans also have to move up and down. But before 2019, the banks have to internally choose their rate, which was MCLR, which is marginal cost of lending rate, which is nothing but the cost at which the banks are getting their funds, which is the CASA, the term deposits, the repo, the operating cost, etc. And they were unique to each bank. So each bank, they have their own MCLR and they used to apply a spread or profit margin over it and pass on the rates to the consumers. But from 2019 onwards, the rates have been fixed at, not fixed but have been linked to external benchmarks. Now what happens? These external benchmark rates do not reset immediately. The time limit defined for external benchmark rate reset is, for repo rate is 3 months, maximum 3 months. And for MCLR, it is generally takes from 6 months to 1 year. Why? As we have already discussed, the FDs, the term deposits, they may be maturing in future period, 3 months, 6 months to 1 year. So that cost of funds, in order to get reduced, it takes at least 2 quarters to pass on the rate to the consumers. And that is why the banks take certain amount of time to pass on the rate cut to you, in the form of reduced rates on your loans, and simultaneously they also reduce your savings rate and FD rates. After April 9th MPC meetings, majority of the banks have reduced their lending rates as well as their deposits rate. So the reduction in the deposit rates cause easy cost of funding for the banks. Their cost of funds, their cost of getting the funds is borrowing is getting cheaper, and therefore they also can pass on the rate cut, the repo rate cut, the external benchmark, which is for the external lending of the banks, and hence the money becomes easily available to the public.